All right, everybody, I think we can kick off. So welcome everybody to this Oxford Bank Governance Program webinar on creating resilient financial institutions. My name is Amir Amelzadeh. I'm an associate professor at Said Business School at the University of Oxford and director of the Oxford Bank Governance Program. I'll introduce the panel in a moment and all my esteemed colleagues, but let me just say a few words on the program itself. The Oxford Bank Governance Program has been running for 2 years now, and this is now the third iteration that will be taking place in July. And the purpose of the program is essentially to equip senior bank managers and directors at financial institutions with the knowledge and capabilities to effectively lead their organizations and navigate the ever-changing regulatory and competitive environment. And the program really runs over 5 days in Oxford, in person, covers topics such as leadership, strategic planning, international bank regulations, risk and capital management, sustainable finance, digital disruption, and other topics. And we really try to get the international perspective in the program. You see this from the wide variety of diversity of the participants, and really hone in on topics that are relevant to bank board members and aspiring senior managers. The sessions are taught and facilitated by various Oxford faculty from the business school, but also from the wider university, as well as invited guest speakers from the finance industry. And of course, as participants, you get ample opportunities to network against the historic background of the Oxford colleges and experience Oxford at its best during the summer months. So not as it is right now, freezing cold. So if for more information, please feel free to reach out to any of us and look out for the Bank Governance Program on the Said Business School website, or connect with Thanuja, who's the program manager and manages the recruitment process on our side on LinkedIn, or connect to me or Kern Alexander on LinkedIn as well. So without further ado, let me introduce the chair and our panel members, who are all alumni of the Bank Governance Program, by the way. So we have Professor Kern Alexander, who is Professor of Banking and Regulation and holds the chair of Law and Finance at the University of Zurich, and is also a co-director on the Oxford Bank Governance Program with me, a long-time colleague and friend. Kern will moderate this panel for us today. We'll have from the left to right on the slide, Gwenole Levenek, General Manager of Bank Transatlantique in London, and also an alumnus of the program. Lebohang Bosov, who's Chief Ethics and Governance Officer at First Rand Group in South Africa. We have Michael Zuring, who is Financial Services Advisor at Deloitte in Switzerland. And we have Christopher Geiger, who is on the Board of Directors of Mid-Florida Credit Union and Vice President of Internal Audit and Enterprise Risk at Lockheed Martin. So I look forward to hearing all the diverse perspectives of all the panelists, who come with a wealth of experience in banking and from different functional and geographical areas. So we will leave time at the end for the Q&A. So please use the Q&A function and in Zoom to post your questions as we go along, as they come up, and Kern and I will pick them up and relay them to the panel at the end. So Kern, let me hand over to you to introduce the topic of today's panel.
Great. Well, thank you very much, Amir. And it's great to have our panelists, alumnus of the Oxford Bank Governance Program, with us today to discuss some of the main challenges and opportunities facing the banking industry, and to consider some more specifically some of the business strategies that banks should consider in turbulent global markets. The first question I wanted to throw out there is, it's kind of a general question. Kind of the bread and butter of the banking business is lending. And of course, we've seen central bank interest rates going up over the last couple of years, and that's led to increased interest rates for banks, for their customers. And of course, that's meant higher profits for higher margins for banks, which is a good thing for profitability, but it's also put customers under pressure. And so I was wondering if our panelists, maybe Gwendolyn might first discuss how banks might balance this trade-off between the increased profitability they get with higher interest rates on loans, and then how do you accommodate customers who of course are paying these higher interest rates?
Yes, thank you. So maybe just a word on where we are coming from in a way. So the last few years, we saw a very tough competition among lenders in Europe, for example, and banks, retail banks, had a strong incentive to lend simply because they had negative rates with the European central banks. So it was a volume game. And you're right, on the other side, they were not earning any interest or net interest income on their deposits. So clearly, I completely agree with you, it's good news to see higher interest rates. Retail banks can start building again margin in their lending business, and they are earning interest on the deposits on the balance sheet. But as you said, there is a big challenge facing banks with big lending book regarding the situation of the borrower, whether it's individuals, households, or even commercial. So this is one risk. The other risk is, of course, related to the security used to secure those loans, whether it's a property for mortgages or financial assets, because the high interest rates means, from a valuation point of view, often that you will see a lower value of the assets used to secure those loans. So the banks are facing two issues. Now it's interesting to see that the regulator in the UK, the Financial Conduct Authority, the FCA, sent a letter in December to the Treasury Select Committee of the House of Commons, highlighting that an estimated number of 770,000 households, mortgage borrowers, are at risk of payment shortfall during the next 2 years. So maybe a word on the UK market. The UK lenders typically fix rates for short time period, 3-5 years, and then for mortgages, and then the rates become variable. So this is why the UK market, mortgage market, is facing such a big crisis with potentially 770,000 households. So it's a huge population. Risking defaulting on loans. I think one issue is coming back in a way to what is the mission of banks, or the purpose of the company. And I think nowadays the view is that banks, or company in general, are acting for various stakeholders. We moved away from the freeman position, or increasing profit for the shareholders, to a much more encompassing position. And therefore, the banks are not just acting for the benefit of shareholders, but for their clients and their communities in which they operate. So in this context, I think the definition of resilience is how banks can absorb shocks, but help their stakeholders to bounce back. So in this case, my view, and I think it's as well the view of the FCA when it wrote to the Parliament, is the expectation is for banks to restructure those loans and to help those 770,000 borrowers going through those financial difficulties. It may mean that banks will have to take losses, and it may mean that banks will have to look at their capital, check their risk-weighted assets and make sure they have enough capital on the balance sheet. So I think it brings back this idea of duty of care, which is a regulatory requirement, to make sure that the banks assist their clients and stakeholders going through these issues. I think another topic, maybe just if I have a few more minutes, is the idea of presence in the communities. So we've seen banks starting cutting costs to improve profitability, and obviously the last few years retail banks have started to reduce branches. We used to have branches everywhere, and a lot have gone. But I think this kind of issue raising by the regulator to the parliament is a fact as well. Banks have to be able to take the temperature on the ground. So they have to remain in touch with communities. And so it doesn't, in my view, it doesn't mean that we need to start opening new branches. But I think the last few years with COVID, we've seen that we or staff can operate anywhere. So we are a computer, you can log and work anywhere. So I think this idea of maybe coming back to a local manager present in the communities, not necessarily with a branch, but simply visiting or being there to make sure that the banks stay in touch with the borrowers. Know your customer, the KYC. So it means as well understanding where they are facing difficulties and getting the early signals. And another point as well is in terms of diversity. There is a lot of talk about diversity, but I think one is as well age diversity, which is maybe not mentioned so much. And we are coming back to an environment with inflation, high interest rates that we haven't seen for a while. In a similar way, we are seeing financial crises, companies, FTX, or the hedge funds last year, Archegos going bust. So I think we need to keep in our staff older people, the old timers with gray hair, who've known a high inflation environment, high interest rates, the great financial crisis. So I think it brings back maybe some kind of old-fashioned ideas of, being in the communities and keeping all the staff.
Great. Well, thank you, Gwynelly. That was a very important observation, I think, especially regarding what you had said was the bank's duty of care to assess how their customers are doing, and as the regulator suggests, to restructure loans if customers are having difficulties repaying their loans. Chris, do you see that type of is that a similar strategy for banks in the U.S. in your experience?
Well, it's a bit different. So in the US, there's a large number of people now who have fixed rate long-term mortgages at historically low rates. And so they don't really have the same repricing risk as I think is in many parts of the country. But what there is then is a lack of volume because they're happy to sit in those homes, right? Unless they need to move somewhere. And that could really extend the duration of assets for them or loans for us. That we may have priced at a certain duration that they may now stay in much longer. But in some ways, we should have seen that coming, right? It's historically low rates. There was a wash. We saw the money come into the system. But that doesn't mean that it doesn't come somewhere else, right? So in the US, for instance, car loans are very much at a premium. Prices have drastically gone up. There's been a lot of buying. So, when there's one market that is hot, there's always another market that isn't. As consumers, we feel that. And banking is a psychological game, right? It's not physics. So I think you have to look at where things are going and not where things have been, and understand where your customer is going. As was just said, I'm actually a director at a retail type bank, and we have maintained branches. There's been a trend to go, to your phone with an app. Of course, we have that, but we've maintained and continued to build branches for the last decade, and even now. And the foot traffic in them is not reducing. There are still folks in all generations that want to go do banking in person. So I think you have to, in the topic of resilience, you have to move into new areas, but keep the old areas as well.
I see. Great. Lebohang, do you see similar challenges in South Africa and the banking sector where you're working?
Certainly. I mean, the cost of living crisis is a global one, felt across the continent in South Africa as well as in other parts of Africa. And certainly from a non-financial risk management perspective, I think for an extended period now, we've seen a great focus, not only from a regulator perspective, but also even one could say from the actors, the corporate actors themselves, a real focus on ensuring that we grapple with issues around affordability, around consumer education, also empowering and equipping the consumer to make the right kind of decisions, understanding their own context. Also an acknowledgement of the fact that financial education, it has been lacking. So you see, as I say, all of these players come together, and there is really this intersection of meeting and of minds coming together to solution and to help people get through this current wave of financial uncertainty. In fact, a recession predicted in South Africa, but the effects being felt on the ground from a customer perspective quite a bit. A focus that we're seeing from the institutions to counter this is really to look at a strategy of not necessarily growing, well, obviously growth is important, but also retaining current customers, so that the costs of new client or new customer acquisition are kept low. And that's really the areas that one really does try to leverage and keep that balance, so that we're not really stifling or harming the consumer more than extraneous events are. And a lot of application of mind as well to innovative approaches around how to, in fact, deal with the relational aspect or the individual relationship with customers. And you're seeing certain things or innovative thinking around looking at whether your capital hurdles would be met from a pricing perspective, so that your product and service pricing isn't really just focused only on the fact that, you know, is this customer customer affordability impacted at the moment, but rather let's look at overall affordability. Let's look at whether the customer is profitable at an overall level, and really looking at that relationship level. I think also the restructuring that Gwenelo mentions, I mean, speaks to indulgences, and every contract we speak about any indulgences afforded, which says, you know, at some point you contemplate that there will be situations that require and circumstances that require deviation from what was initially agreed. And so you're seeing a lot of that as well at a relationship level, engaging with people in acknowledgement of the fact that life happens, circumstances beyond one's control, and how do we partner, how do we collaborate with the customer to maintain that balance.
Right. I'd like to turn to the issue of competition and resilience for banks. We heard Chris discuss how his bank in Florida is building more branches. They're reaching out to customers physically. And of course, we know that neobanks and fintechs are a source of competition for the traditional bricks and mortar institutions. Michael, what do you think about the role of the fintechs and the neobanks in providing competition for the traditional banks that we were discussing?
Yeah, hi, Karen, thanks. I think, look, something, I mean, it's going to be interesting to see how they continue their momentum that they have been making over the last couple of years. But I don't think at this point in time there's anything that has been groundbreaking in the sense of brand new technology or something that would be massively disruptive to put the large banks at risk. Now, I'd say, having said that, I'm not suggesting that they are not at risk. I mean, if you look at the years that we've taken from the credit crisis some years ago, and even just more recently from the market dislocation that we encountered recently with COVID, you know, there's been several material scenarios where markets have tanked. The banks, yes, went through some very difficult periods, but they managed to turn it around. But that external factor has been market related. And what I haven't seen take place with the fintechs and these, you know, spin-offs is a real, well, for the lack of a better word, an attack on the way the model is currently and has been for decades with the large banks. No one has really come along and dethroned the current business model that banks are using and continue to use. They remain very much in their old models. They're highly inefficient, remain costly. You know, and I'm sort of waiting for a smartphone scenario. You know, you take 2008 with a smartphone, and it didn't take much. You know, I think what 2-3 years before BlackBerry was on its knees, and this kind of scenario I haven't seen yet, and I'm not sure I've seen the technology yet, or you know, a groundbreaking fintech come along to do a similar scenario as the smartphone scenario that took out a BlackBerry. But banks are simply not immunized against these smartphone scenarios, and it will inevitably happen.
I see. Well, in Europe, Gwendolyn, we have the Payment Services 2 Directive and open banking, kind of sort of a new phenomena, a new trend. Do you think that is going to really have an impact on the competitive landscape in European banking?
Well, I mean, my experience so far, if I remember correctly, the PSD2 came into force, I think in 2018, I think something like that. And so it's been a few years now, and from my experience, I haven't seen much request for, you know, from clients to share data and, you know, access with third parties. You know, so it's, I'm not sure if it is an education for or awareness of the retail clients about disability, and it's still very limited to maybe the younger crowd who are more tech savvy. But the you know, 4 years after, from my experience, this opening that the PSD2 offered to clients has not been really taken or used so far among the client base I can see. So in this context, I kind of rejoin Michael in the sense that banks so far have not been under siege really, or intense, have not been really challenged so much by the neobanks. And yes, you see some services. Obviously, we see for FX or, you know, sometimes transfer. You know, e-payments, FX transaction that used to be a high margin for banks. Now it's kind of gone for, it's being commoditized, and but this is not banking. This is the operators with this FX transaction or e-money do not have banking license often. And in the UK, you know, like a neobank, like a Metro Bank, you know, has been really suffering the last few years from regulatory issues, you know, balance sheets, capital requirement issues. So I think it kind of highlighted you know, show that to the consumer at the end that it may be there's kind of question of safety there. I don't see yet, as Michael said, a BlackBerry moment for banks, but I think we have to be aware that we have to be you know, kept on our toes, and therefore be really careful. I think where I can see sometime where we are lacking against newcomers is really the interface. Our system, I think, as Michael implied, you know, our IT system are quite old often, and therefore not as flexible as agile as newcomers. So I think the interface, the customer experience is often not as good for incumbents.
Okay, great.
But it can be remedied.
Great. Chris, how do you see the open banking phenomena developing in the US? Of course, they've got a different regulatory framework from the EU. Do you see the market pushing for this, or is this something more policy driven?
Yeah, exactly. I think it is the opposite. So we don't have regulation around it, or not specifically in the US. And that's not what's driving it, but customers are driving it. So there's an innovation aspect. I think we're actually late to the party. So I think it started out in Europe, but we've maybe taken it a little further. And because it's pushed by innovation, I will say though, it goes both ways. So our customers are asking for it, as was mentioned, not just foreign exchange or money transfer, but in lending, small lending, different creative aspects. But in many cases, those fintechs need us as the balance sheet too. So this is an opportunity for banks, because if they're going to do lending and they don't have a banking license, they need large or small, institutions to be that back office. So it really needs to be a way to go as an opportunity and not just a risk. And if you're, depending on where you are in the banking ecosystem, if you are in the retail and you have, physical locations, you're probably not going to compete with every fintech, right? On every niche of electronic banking. So this is a way to really compete with the larger competitors, because you can make those partnerships into your own members, right, or customers. The branding can often be very unified. So this is a way to put together maybe a compelling and resilient opportunity that really that at this point is not regulation driven, but business driven.
I see. Okay, that's a very important point there. Thank you. Let's turn to risk management practices and how they might be changing now to new challenges in the financial markets. Lebohang, I was wondering how your institution might be grappling with the growing financial risk associated with climate change, for example, and how that's affecting traditional risk management processes.
I think I'll speak to the broader landscape, just in terms of areas of priority, and really what the banks in South Africa are looking for. And that's really a lot of thinking around products and services, the opportunities that one could potentially pursue that come out of the just transition. And then also from a lending perspective, ensuring that we play a key role not only in facilitating, receipt, but also proper use of funds. Corruption remains something that is spoken about in relation to deployment and receipt of be it grant funding, loans, etc. And so seeking to play a role in that to ensure again that when we speak about this widespread or cross-spread of stakeholders, that the benefit really does accrue to those stakeholders, including society, because obviously climate change being something that impacts the corporate sector, it impacts our investors, but again, very much the communities in which we operate, the markets in which we operate, etc. And that's the role that I see players seeking to fill.
Great. Thank you. Gwynele, I was wondering what you thought about in the context of sustainable finance, how banks are beginning to manage the risk surrounding greenwashing and the potential mis-selling or designing products that are classified as green, and how that what are the risks there for your business?
Right. If I just come back a little bit on residential quickly, and it's related as well to your question, is the fact that I think on climate change issue, whether it's new regulation affecting the consumer, the end client, or us, there is first of all a lack of maybe education or information. I mean, I'm going to just an example. Starting this year, we have a new regulations in France that prevents renting of your property, let's say buy to let, if the property does not meet certain criteria in terms of thermal insulation. Okay, so and the law came into force this year. It was passed by the parliament, I think 1 or 2 years ago, and it will get tougher and tougher with the criteria getting stronger until 2028. What I've seen is some people falling, clients falling from that chair, were completely unprepared by this regulation coming into force, and therefore suddenly realizing that their portfolio of buy to let could not be lent anymore because they are not meeting certain criteria. And it's kind of surprising in a way because it's been in the newspapers. But now they are waking up too late, and the value, they can't be rented, and obviously the market value of the properties have gone down. So I think on greenwashing as well, it's obviously it's related to the fact that there is a lack of education. Really, the end customer and the banking, employees in general, there is a lack of awareness. So I think in a similar way that banks have done a lot of, training and competency for the staff, the famous in the UK called fit and proper, having the knowledge and competence. I think that there is a huge education exercise that has to be done by banks, starting with their own staff. And then educating the customer. I think Lebo said earlier, financial education, but as well on the climate change. And I think this will avoid the greenwashing. This is one way of avoiding greenwashing. Obviously, the regulations are getting tougher, and we see litigation coming up. So I think, and we've seen recent example of high street banks being sanctioned because of greenwashing on their advertising. So I think we are going to see hopefully increase awareness from employees, making sure that they don't miscommunicate and be not misleading in their communication, greater education of customers, and obviously we're going to have the regulators on our back, making sure we are communicating, disclosing properly. So I think we have a whole batch of regulation in the EU, but as well in the UK coming up, or actually there. I think most of them are coming into force this year actually, and it's going to be very interesting to see how well we are behaving.
Michael, I think Gwenole had mentioned regulators getting stricter on green finance issues in Europe and in the UK. Regarding regulation, do you feel that regulators have been too lax on enforcing the regulatory rules with respect to operational failures, specifically involving fraud or corruption?
Yeah, I mean, look, I think the ECB's have been doing a good job, as has the Fed, of course, who was the lead on this as they went into the credit crisis initially. But I think, we believe in the finance environment that we've been doing a good job all these years. And then all of a sudden we have another scenario that pops up, 2 years ago with one of the banks here in Switzerland here, right? Where you have, some serious breaches that take place. I mean, one aspect that I think has been working very well, and it could probably be implemented more so, is these processes, controls, frameworks that require, and this is born from Enron, of course, and I know Christopher, you may probably, of course, Christopher will probably have some good insight on this coming from the US. But I mean, SOX 302 is a fantastic structure, and I think has done a very good job in avoiding a CFO or CEO saying, sorry, I didn't know. And I think this is going to have a knock-on effect as well with regards to how, if they can implement this kind of controls and processes and controls within the finance area for greenwashing, and how banks are reporting all these good things that they're doing. I think this will be very, very critical. Yeah, I mean, it's a critical aspect, and I think banks, they can't afford to lose their. I think one critical aspect for resilience is trust. You lose trust, and that's just a very standard, very basic element for long-term relationships. And if you lose that, then you might be seeing scenarios that we have here in Switzerland with one of the banks. They need to do more. I think it's still cowboy country with regards to regulation on green and climate. And it's no one's fault. It's just because it's such a large topic that it takes, and it's a very complex topic. I mean, as you know, Europe can be somewhat can be fragmented. So they need some work on this, and it will, it needs funding, and it needs ultimately leadership from the very, very top. That's where it starts, to say, we're taking this seriously and we're going to do something about it. It's certainly not cowboy country like it has been in the past, like for such things such as carbon trading, where that had also the best intentions back 2007, 8, 9, 10, etc. Carbon trading was something that had good intentions, but also was struggling because you didn't have a symmetrical approach to regulatory initiatives, given the amount of countries that it was dealing with. So yeah, long way to go, current, I think, still.
Right. Yeah, well, regarding the regulator, one of the important areas where the regulator is playing a greater role, both in Europe and even in the US, is in disclosure requirements. And I was wondering if Chris might comment on some of the new disclosure requirements that listed firms such as his bank are subjected to regarding sustainability or other so-called non-financial risk disclosures.
Yes, I mean, there's a lot of news here in the U.S. If you haven't been following it, earlier in early 22, two big proposals came out of the U.S. Security Exchange Commission. One was around climate reporting, and one was around cybersecurity reporting. And both of them were meant to happen very quickly. Now, they're still proposals; they aren't completely done yet. But they intended people to be able to report essentially on the year 2023 data in 2024. Now we're already in the 23 and the rules aren't final, so I think we can imagine it's going to be off a year. But every listed company in the US had to immediately get their act together if they weren't already there, and with less than a year to be ready to measure greenhouse gas emissions in a way that was going to be put in SEC documentation, so in their proxy or in their 10K. If you can imagine, that's going to be through SOX compliance, right? That means your executives are going to be, signing up for this data just like they do any other data. And this would be the first time for almost any U.S. listed company for them to put, say, their scope 1 and 2 emissions in a document like that. It's usually published elsewhere for good reason. We don't have, most listed companies, right, don't have essentially an accounting system for their greenhouse gas emissions. Now, the bank that I'm at is not publicly listed. We're a smaller organization, but I don't think that means that, if you're not publicly listed, you can ignore this. Because you have to understand scope 3 emissions and the way this completely affects the entire economy. So the vast majority of the economy isn't in the US in listed companies, but we are part of the supply chain or part of the financed emissions of them. So every client you have, if they're listed, is going to be now doing this. And you may be asked by your members, every time you do a loan, you're going to have new access to new data. It's just an entirely new area that you have to keep an eye on. The financed emissions I mentioned, highly, not well defined on who's going to include various things. So look at it as an opportunity, I would say. You ignore it, you're also going to ignore the opportunity side of this. The banks that get this right are going to use this not for greenwashing, but for making an advantage, and for having their own customers come to them and say, oh, this is who I want to bank with, because they're going to help me meet these requirements.
Great. Lebohang, do you see banks in South Africa, are they coming under any pressure to disclose, for instance, their greenhouse gas emissions or their exposure to firms that might have high greenhouse gas emissions?
Yes, absolutely. The pressure exists. I mean, the listed companies as well from a listings rule requirements perspective, but also, I mean, the funder investor conversation, employees, when we speak about trust earlier as well, and again, going back to the various stakeholders that we now have to concern ourselves about, when we speak about millennials who now make up the vast majority of our workforce, they ask questions about that in assessing whether you are a desirable employer, in assessing whether one wants to build a career and in fact can remain in an organization. So these pressures these pressure points are felt across the board. And so important to look at these disclosures. And I think, I agree with my colleague, Chris, who said that you need to achieve a balance, because I've always been a believer in the fact that the story cannot remain untold. But you need to tell it in such a way that it is clear. It does not create misconception. It does not, or is not intended to, or does not inadvertently fool anyone into believing that you're telling a story different to what you have actually achieved as an organization. Again, not avoiding the difficult conversations, because that in and of itself, could be seen as a form of greenwashing. But definitely the pressure exists, and there's a lot of thinking on the continent as well, and in South Africa in particular, around how we deal with these disclosures across the landscape of ESG, including human rights, climate, and the like.
Thank you. You mentioned employees, and I was going to ask Gwynele how his bank is, what type of strategy generally you might have regarding building a resilient workforce. This is, of course, important now as the economy goes through turbulent times. And how is your institution thinking about the best way to equip its workforce?
Yeah, I mean, so coming back to the notion of stakeholder, we've been mentioning a few times today. So obviously your employees are one of your stakeholders. So the bank, the employer, has to obviously look after them and make sure that they can bounce back or going through maybe the coming years fine. So the banks or the bank for which I work, or many French banks, have actually looked at remuneration either as a one-off kind of bonus to help them facing a higher cost, or I should say increase salaries. So this is definitely something I've seen across French retail banks. So this is one point. And now in terms of long-term resilience, let's put aside maybe the coming recession in Europe, but we've talked a lot, I think, today about training competencies, and therefore I think the need to constantly, whatever age of your staff, your employees, it can be obviously it has to be related to the activities, but it can be in various things, maybe less obvious. For example, we talk about climate change, or all the ESG is obviously a big part of it. In private banking, a big topic right now is philanthropy. All the charities. A lot of wealthy families want to have an impact and set up their own foundation. So how to advise. So a lot of employees want to be trained on philanthropy in general, and impact investing, and all those kind of social investments. So it is a big topic among employees.
Well, yes, level hang. Yeah. Yes.
Thanks. I know you didn't follow me, but if I might,
yeah.
All of our organizations have rafts of policies, reams, in fact. And I think an important thing to focus on is ensuring that these things are accessible to people. And not only from a reach perspective, it's on app, I can access it anytime, but also, we talk about the technology that's available, chatbots, AI, etc. Are we using that to create resilient employees? And not only just from an external facing and customer facing perspective, are we really leveraging the digitization, the technology that's available, and again, ensuring even in the way that we communicate, that we're understanding. And I remember as part of the discussions on the program, we discussed the different cultures that exist in different parts of for instance, a vertically integrated and large financial institution. The way in which you speak and engage with your investment bankers is not going to be the same way that you do with your retail banking population or your branch staff, for instance. And so are we ensuring that those policies are interpreted, understood, and resonate with those different parts of our communities? And I think that's vital to ensuring a resilient culture among our employees.
Right. Chris, do you, in the US, do you see institutions such as yours having equally a great concern regarding building a resilient workforce?
Certainly, yeah, not immune. I would say that really you want the key in the tight labor market, as the U.S. has, is growing people, right? Not looking for the perfect person outside of your organization to bring in to say fill a key role. But you know, look, banks are often pretty much like a pyramid, right? There's a lot of employees, at least in a retail banking, that are facing customers that are doing the day to day, and so you need to take advantage of having that amazing workforce and bring in management, oftentimes from that level, and not try to get it from the side. If you want to build a culture, right, that is customer focused, similar to a lot of other U.S. brands, right, that really bring people in, you have to do the work, and then you can move up and understand how the organization works. That's certainly how we operate, and I think there's a lot of benefit to that, rather than trying to change the culture some other way.
Right, I see. Well, we're getting to the last quarter of our discussion, and so I wanted to turn it over to our audience to see if anyone has any questions. Feel free to post your questions in the Q&A or in the chat box, and then for any of our panelists and to continue our discussion. As you ponder your questions, I might ask a follow-up on the competitive landscape and how or what are some of the other emerging technologies that you see in the banking industry that might change the competitive landscape in the near future? Does anyone? That's kind of an open question to our panel.
Well, I'll jump in there first. We've what I've seen in InsurTech, right, and the use of data to adjust rates for your insurance. I haven't seen move to loans as much. I understand that I'm sure someone's trying to disrupt that right now. But using data, and especially in the US where data on nearly everyone is very available, is likely a place, there's already a lot of loans happening where no one's checking a traditional credit rating. They're using this other type of social data. So I think using InsurTech maybe as an example and moving in that direction, I could imagine that there's a lot of innovation coming that really uses the data that you don't realize data brokers have. Similar to people don't think about a credit score when it's there all the time. So as that data gets used more, that may increase the velocity, right, of the economy. We thought it was fast now, right, with what credit cards have done and other things. If money can move faster, everyone gets more use out of it.
Levelhang, I was wondering if you might share your perspective about data in the South African banking sector.
Certainly. I mean, I think from an internal facing perspective, so useful in understanding behaviors, shaping culture, and all those things we've spoken about as well, ensuring the resilience of our workforce, of our employees. But then from a customer perspective, also a great focus on that, again, to assess whether or not, a lending decision, again, credit decision, we have vast amounts of data, but we're not using it to, as effectively as we might. So there is a realization of that, and really great effort to try and harness the data that we do have. But the big driver here, one of the big drivers, which I think is a differentiator in other geographies, is really the historically disadvantaged, those who perhaps would not previously have had access to credit. So to have built up a record, and so your traditional data sets won't necessarily allow you to have a fair view of potential prospects and changing circumstances. And so use of non-traditional data you're seeing being leveraged from that perspective. Yeah, promoting financial inclusion.
Well, that makes a very important move to another area of sustainability. We talked about climate change and greenwashing, but of course, social sustainability is an important on the agenda, and financial inclusion is viewed to be an enabler of social sustainability and social inclusion. Do you feel that the banking sector is reaching out to those disadvantaged groups in your country? I'll probably ask everyone that panel. on the panel, but we'll start with Lebohang.
I'm seeing a concerted effort. I mean, I think one sees a number of the major players in the financial services industry. And again, the jury's out on whether it's driven by the regulator, because that is obviously a big focus. For instance, even in the digital transformation journey, our conduct authority, the equivalent of the FCA in the UK, really quite focused on ensuring that we then don't lock out those in rural areas, for instance, when moving to more digital interfaces, that we ensure that there is still a bricks and mortar presence to an extent, that the aged who are perhaps not as comfortable with the technology are also served, that those who, and again, diversity from a language perspective, being relevant in the country, from an education perspective, skills perspective. So a great focus. And as I say, I do wonder whether it's primarily driven voluntarily by the, from the bank's own volition, or from a regulator perspective. But whatever is driving it, there is that focus, certainly.
Great. We have a question. We have a couple of questions in the Q&A. I thought the first one is from Mr. Nagy. He says how important it is to stick to a conventional model and not to be carried away by the fintech revolution, or vice versa. Michael, do you have any view on that? Do you think we might be carried away by fintech, and that we should maybe keep one leg in the traditional banking model? What do you think?
Yeah, great question. I mean, certainly what is going to be the case for the next couple of years is a much more stricter approach to how fintech is going to be evaluated. So these, calculations around evaluating an IPO or a spinoff, or or a private equity high net worth individual looking to invest into a spinoff. I think one thing that is going to cool things a little bit, in the sense of this euphoria that we've been seeing when we had a lot of, well, cheap money, if not free money, was valuations on these new companies just didn't seem realistic, right? So I think there will be, this point number one, I think there will be a cooling off of the evaluation calculations that have been typically used. So, where somebody was doing an IPO a year and a half ago, maybe they got a 2.6 gearing. Now maybe that's going to be dropped to a 1.4. So I don't think that will suppress new technology or fintechs coming along, but I think it will certainly bring a little bit more reality back to, or shall we diminish the euphoria that we've been seeing the last years on new startups. You got to keep an eye on the new technology, or else it catches you off guard for sure. I think from a big bang perspective, you're seeing some banks stepping away from adopting brand new technology and doing a big bang approach to implementing it within their organization. Costs a lot of money, a lot of time. It uses up a lot of resources from their day jobs, and it doesn't necessarily work. So I think some of the bigger tier one companies are hesitating more so now to go into these large implementations to gain that technical edge that they thought they were going to get, but they didn't. I mean, I think cloud is a perfect example of that.
Okay, great. Thank you, Michael.
Sure.
We have a question from Chet. I might pose it to Gwynele. He asked, how do you feel the use of analytics will impact banking success going forward?
Well, I'm going to come back to lending again, and we talk about data and everything. So I completely agree. Something that kind of I think we will have to review our process is to assess a loan application, lending, using more maybe scenario analysis. That is to say, if you consider that climate change brings a lot of uncertainty, we know it's coming, but we don't know that there is a range of outcomes, and therefore we don't know exactly where we're going to end up. So I think the scenario analysis for me is something very interesting, simply because you could review your loan and the real estate you're financing, long-term project, 10, 15, 20 years or even 25 years. So therefore, really going to be affected by the physical risk of climate change, taking into account or using scenario analysis. So for me, the analytical is more using those kind of tools.
Okay. We have another question about, I'm sorry, Lebahang, did you want to?
No, I'll keep it brief. I just wanted to say, I mean, while it's quite exciting, capability, the different use cases, etc., we also need to, I suppose, caution ourselves around some of the pitfalls, ensure that we're monitoring things, reviewing that what we actually seek to, achieve with analytics is the actual outcome put out by the various models we're using, understanding biases, not using protected grounds to sort of make determinations around lending, credit decisions, etc. So I think important for us in our organizations and our boards as well, to become au fait with these concepts, because while, yes, it's exciting, there's a cautionary tale in there as well.
Okay.
Maybe I can jump in here briefly.
Yeah.
Because there's two related questions as a follow-up to this before we jump to Mustafa's question on capital requirements. And there's a question from Khan and Rihan again. So the question are essentially related in terms of, on the one hand, banks are obviously using and implementing fintech and analytics to attract the younger, the millennial customers. And Rihan said as well, how do you ensure then that you actually encourage millennials and the younger customer generation, if you're still approaching this from a traditional banking approach and not the more aggressive fintech approach? And then the opposite of this is what Khan says, but what if in your customer base is actually not that technically astute, or part of that customer base is not technically astute? So how do you make sure you're not losing them if you're shifting too aggressively into fintech? So that's kind of a fine balance, and how to balance those two. Anyone who wants to?
Yeah. If you,
Chris, I think you have a good.
Yeah, well, I was going to say, I mean, I mentioned earlier with the open banking, right, the partnership aspect. So you have to do all of the above. That's what resilience is. Resilience, in an organizational sense, is living through realized risk. And all of these things are risks, right? Your business model's being disrupted, other things are happening. You can't get too comfortable. If you're too comfortable being two on one side or the other, you're not being resilient, right? Resilient isn't the most optimal, but it's the most likely, and I'll use that sustainability word, but in a different sense, to be around in 100 years. And that's what sustainability is really supposed to mean, is that you have an organization that lasts in the very long term. And so we all know that technology comes and goes, and it's what your services are to your customer that should be the most important, not the tool.
okay, great. Well, I think we're running up close to the end of the hour. Do any of the panelists have any final comments or observations to make?
Not a general one, but just related to this discussion now. And I think quite a bit of the issues are analogous to what we've had to deal with in having bits of the population and our customer base living different realities, right? You've got developed and developing world all in one in South Africa. And so it's been about transition, and it's been about making it a managed change. I mean, if we think about something like the Industrial Revolution, it's a bit of a misnomer, I think, to call it a revolution, because it took a long time, 100 odd years. And so even now, in using and transitioning perhaps to fintech, I think the earlier comment around keeping a foot in both is where we are at this present point in time, but then ensuring that we've got the capability over time to keep the interest of those who want to make use of those, that type of model of banking, and also catering for our employees from that perspective as well. My view.
Great. Thank you. Well, we've run up to the end of our hour. Are there any last comments or observations? If not, I want to thank our panelists for coming on from different parts of the world to share their perspectives on the challenges and opportunities facing banking and the idea of resilience for financial institutions. It's been a fascinating discussion. I'd like to turn it over, and I also want to thank our attendees who joined us and asked very stimulating questions, which are spot on. So thanks very much to our participants, and we look forward to engaging in further dialogues with you in the future. And if you have any questions about the Oxford Bank Governance Program, feel free to direct them to me or to Amir or to Thanuja. Amir, do you have any? Okay.
I'll leave it at that. Thank you very much, everyone. Thanks to the panelists. Thanks for everyone for joining. And if you would like to contact us, here are again the contact details, as well as obviously you can contact me or Kern directly over LinkedIn or by email. So thanks again, everyone on the panel, for all your insights, and thank you for joining us this afternoon. And thanks, Kern, for moderating this panel so astutely. Thank you very much.
Thanks, everyone.
Thanks very much.
Thank you.
Have a good rest of the year.
Okay. Cheers.